In 3 years of this channel, this is the first time we've had to do this. But once, we made a video calling SVOL the best income investment we'd seen, and we can no longer stand by that statement. We did pin this comment up when we found out, saying the SVOL portion was no longer valid given the overhaul of the strategy, and this is the, admittedly related, follow-up review that we promised. So let's dive into what happened. I'll start with a quick recap of what SVOL did before and why we liked it, and then we'll discuss what's changed and why I no longer do. If you're not familiar with SVOL, what made it great was that income was generated by shorting the VIX rather than selling call options, and shorting the VIX doesn't cap your upside. I thought they also had good risk mitigation strategies in place to minimize the chances of taking on too big of losses. They said they wanted it to have similar risk potential to the S&P 500, and I thought they would likely be able to achieve that with their strategy. So, similar risk, possibly sustainably high income, unlike most high-income strategies, which I think are completely unsustainable. The key was in most returns coming from shorting the VIX. Well, that's not what SVOL does anymore, and what they do now is much less attractive to me. It started with some research they did that showed them that short-term VIX futures had gotten more volatile compared to US large-cap stocks. You can pause and read this if you want, but that's basically what it says. So what did they do in response? Well, they said they implemented 3 proactive measures to enhance diversification and stability. Number 1, they would start selling lower beta, aka lower risk, VIX futures further out on the curve. Now, before we get to number 2, one of the risk metrics they had on before, which I liked, was that they would dynamically switch between short-term futures and long-term futures depending on the risk-reward at the time. What you're looking at here is a slide from our first SVOL video that I updated to include a current VIX futures curve on the right. Those are the prices of the VIX futures that expire in August, September, etc. Notice how they go up over time? That's called contango, like the blue line in the chart on the left. And that's how the VIX curve is normally structured. The main source of return when shorting the VIX just comes from what's called the, quote, rule yield. If you maintain a 1-month average maturity, it means you short, aka bet to go down, some of the front month future, which expires in less than a month, and some of the second month future, which expires between 1 and 2 months from now. So you'd own whatever portion of those two gives you an average maturity of 30 days. But every time a day passes, your average maturity would go down to 29 days. So you'd have to alter your exposure. And since we're short here, that means selling a little bit more of the second month contract that's further away and buying a little bit more of the front month contract. The front month contract is usually at a lower price, buying low and selling high to maintain that exposure. Beautiful. So there are 2 key things to understand here related to the change that SVOL made. First, you get a higher return from roll yield when you focus on shorter-term futures. Look at the difference between the prices of the August and September contracts, about 1.7. But between September and October, it's only 0.6. And between October and November, it's only 0.1. And from there, it's pretty minimal across the board. These change daily, but this is a pretty typical pattern. So when they say they will switch from dynamically changing between short and long-term futures to just mainly focusing on longer-term futures, what does that mean? That means lower returns from their primary source of return, which was what made this so attractive to me in the first place. And that means they'll have to make up that return somewhere else, which we'll get to in a moment. Why would they do that? Well, the second thing to understand from this chart is that when volatility spikes and you go from the blue line to the red line, all VIX futures go up, and you lose money no matter what if you were shorting the VIX, aka betting on it to go down. But the short-term VIX futures go up a lot more than the longer-term ones, meaning your losses would be much greater on the short end. So higher risk, higher reward. I never expected them to be perfect with their timing, but like most investments, sometimes you get paid more to take on risk than other times. And I liked that they would at least attempt to dynamically go with longer-term futures to take the risk off the table when they were getting paid to take the risk, and they'd be in shorter-term futures for higher return potential when they felt like they were getting paid to take the risk, which is the vast majority of the time. Okay, so change number 2 was that they said they were going to start hedging against tail risk, which they actually were already doing. That basically just means putting strategies in place to mitigate losses in the unlikely but worst-case scenarios. And number 3, Here's what they did to get the extra return that they're no longer getting from the VIX futures. They will maintain equity beta for NAV participation. This is their new strategy to meet their core objectives of generating a yield 10% higher than the Fed funds rate plus NAV stability. What does that all mean in English? It means now less than 30% of the portfolio will be in VIX futures. They say they'll still be active with their positioning, so maybe some of that dynamism I liked before will still be there, but it sounds like either way, this will be a way smaller portion of the portfolio now. And so then how are they going to hit that yield target while maintaining equity beta for NAV participation? They're going to put over a third of the portfolio in S&P 500 ETFs and S&P 500 call options, then sell S&P 500 call options for income generation. Translation, this is a freaking glorified S&P 500 covered call ETF now. Ugh. And how has this worked out? Well, let me remind you of the historical return pattern. Typically, they would trail the S&P when the market was going up a lot. That's the gray shaded areas. Then they'd outpace the S&P when it was going down, then trail them on the way up, outpace on the way down, and you could get to a similar place over time, but with higher income and lower volatility. Not bad for an income strategy. Then, at the beginning of 2025, they changed their strategy. The market sold off in February and March. They sold off twice as much. The market sold off in April. They got absolutely decimated. The market recovers in May, and they catch up. This looks more like a leveraged S&P 500 position to me, honestly. In fact, here's SSO, which is a leveraged S&P 500 ETF, and look how similar that return pattern is. Well, on the downside anyway. But it mainly didn't participate in the upside, likely because of the covered call positions. So, cool, you get leveraged S&P 500 exposure on the downside and capped upside from the covered calls in the recovery. No thanks. In my opinion, SVOL is broken. There's no longer anything special about it. I no longer stand by it, and I'm sorry we were so supportive of it when it had its prior strategy. Had I known they were going to change that, we never would have made a video about it in the first place. I'd love to say the moral of the story is always check to make sure the investment process of all your investments stays consistent, and I guess in a way it is, but honestly, you really shouldn't have to do that. This kind of thing very rarely happens in the industry, and it honestly would give me pause when considering any investment from Simplify in the future. I hate having to make videos like this, and like I said, this is the first time we've had to in over 3 years since we started this channel. But ultimately, we're here to help you make better investment decisions, even if it makes us look bad. To be fair, we also told you how to protect yourself from the coming market correction on April 2nd, then reiterated our preference for non-US stocks over US stocks, which have continued to dominate since then, and then we told you about the talker trade before it became a thing, and highlighted investments that are up significantly since April. So, if you invested in SVOL, hopefully also some of these other videos helped you as well. I haven't found any other high income strategy I really like it, but I'll definitely keep an eye out for it. And in the meantime, if I were to create a retirement income strategy, this video shows exactly how I would do it. So that might be a good next watch if that's what you're looking for. We will keep bringing you investment ideas, market commentary, and other content to help make you a better investor. So hit that like button if you enjoyed this content, leave us a comment with what you'd like us to cover next, and subscribe so you won't miss it. We'll look forward to seeing you in the next one.